Welcome, welcome, welcome. Today we are looking at the monetary policy. Monetary policy, along with the fiscal policy, help to establish the short and long-term effects of the United States economy. Monetary policy is changing the rate of growth of the money supply and circulation to affect the cost and availability of credit. We have our money here. It's the creation that the government intervention that we know in a mixed economy when there is government regulation helps to slow or speed up the economy as necessary. The Federal Reserve System is the central bank of the United States. It's known as the Federal Reserve, or more affectionately, the Fed. The chairman of the Fed controls and coordinates the Fed's activities. And this is Janet Yellen. She is the first female chairman of the Fed, chairperson. The president appoints and the Senate confirms the chairman of the Federal Reserve Board. Former Fed chairman was Ben Bernanke. You might know that name, might be familiar from the period of time after the recession. And after Ben Bernanke, like I said, we have Janet Yellen now. There's Ben. Okay, the Federal Open Market Operations Committee, or the FOMC, is the policy-making group within the Fed. It's made up by 12 members, and they set the monetary policy, which helps to manipulate the money supply. Basically, we have people from in a representative area because we don't want to have someone from New York or Philadelphia making decisions about what's going on in San Francisco. So we have our representative area because we know that these districts or these regions, in the United States, it's just the monetary needs of one place is very different from that of another in another part of the country. The function of the Fed. So the regulatory functions are to oversee and regulate large commercial banks. The Fed basically keeps a check on these large commercial banks. They also enforce the laws concerning consumer credit. One of the basic functions of the Fed or daily operations is to act as the government's bank. So they hold the government money, they sell U.S. bonds and treasury bills, and they manage the currency or the money in circulation. They are the banker's bank. Commercial banks borrow their money from the Fed. That's why they're also in charge of overseeing and regulating those large commercial banks. So we have two ways that the Fed can regulate the money. They can regulate with loose or easy money, which is when money supply is plentiful. There's lots of cash out in the market. This is good when it stimulates the economy. Unfortunately, if you just keep printing money, inflation will start to rise. And then you have more money chasing after the same amount of goods. Now, if production is also increasing and you then increase the print money, then you can stabilize the inflation. But when the Fed decides to print more money to stimulate the economy or work with a loose or easy money system, it will eventually cause the inflation to rise. And what is also bad about that is that everything begins to cost more. And so if you're not a person who's getting paid more, you might feel the effects of the inflation in your coffee prices or in your groceries or in your rent. And then finally, it always seems that you only get paid after you've had to pay the bills a few times. The tight money system is when money supply is limited. It helps to control inflation, however, so that's a good thing, but it slows economic growth because there's not as much money out in the economy chasing goods for people to spend. So here are some of the tools of the Federal Reserve. We have the discount rate, the reserve requirement, and open market operations. I'll describe each of those. The discount rate is essentially the interest rate, but it's the discount that the Fed charges banks on its loans. So the bank is going to come, Bank of America comes to the Fed and says, hey, I need a loan. Okay, well, the Fed says, all right, I'll charge you 1%. And the bank says, okay, great. I'm going to take this money and now I'm going to loan it out to people who want to buy a house or start a business. I'm going to turn around and I'm going to loan it out for 3%. So the bank makes interest, it makes money, and also the Fed is making money on the banks. Okay? So they get a discount rate for going to the Fed. The banks and the Fed are kind of like working associates. I don't want to necessarily say that they're friends, but they're working associates. And the Fed gives them a discount rate. It is an interest rate because they still have to pay for it. It's borrowed. They're paying money on the borrowed price. But it's not going to be as high as what we as consumers have to pay as an interest rate when we go to the banks. So let's say that the current rate is 0.75%. That means that if the bank borrows $100, they have to pay back $100.75 in 1 year. The interest on 100 is 75 cents. If they borrow 200, then they have to pay back $1.50. Increasing the discount rate slows the economy because if the discount rate to the bank is higher, then the bank is going to charge us an interest rate that's even higher. So the interest rate being at 0.75 or even at 1%, I think it's up to 1% right now is the targeted Fed discount rate. The banks are going to turn around, and there are a lot of other factors, but they might hand out loans for houses or mortgages or something around 3-4%. That's an interest rate from a bank. If the bank has to pay 4%, then we are going to end up paying like 10%. The interest rate is going to be huge. Nobody's going to get a loan from a bank or try to buy a house, which means that the economy is slowing if it's too expensive. Right, because it costs more to borrow money, which is what I said. Decreasing the discount rate stimulates the economy. It can't get much lower. It can be zero. It was at zero. The Fed has only just recently raised it back up since the recession. But there haven't been increases in the discount rate in a couple of years. So just recently, I think at the holidays, they increased the discount rate. And that changes the economy. Folks think that, okay, it's going to be harder to borrow money. It also created in the housing market a bit of a rush for folks who wanted to buy their houses before the discount rate went up at the end of 2016. Right, if it costs less, people are going to borrow more. The reserve requirement is a certain percentage of deposits that banks have to set aside as cash in their own vaults or as deposits in the Federal Reserve District Bank. Currently, that reserve requirement is at 10%. If they require that the bank keep a larger percent in the vault, then there's less money that the bank can lend out. We know that when we go to the bank and we deposit $100 into our account, that the bank puts that money into the vault. They keep some of it for us, that has our name on it in the vault, but they borrow from us and lend out to other people. If they increase this percentage to 50%, then when you put $100 into the bank, 50 will stay there, 50 will be lent out. If you go to the bank and you put $100 in and they only have to keep 10, then that means that $90 can go out and be lent to other people or to businesses so that they can buy things. So when you make it harder for the bank to lend out money, then it's harder for people to get loans. When you decrease it, just the opposite, when you decrease the reserve, I don't know that it goes much lower than 10%. We have very low federal requirements for both the reserve requirement and for the discount rate right now because those numbers are only just increasing still since the recession almost 10 years ago. But when you decrease the reserve requirements, it is going to stimulate the economy. So Right, that's a lot. But let's see that increasing the reserve requirement is tight money, decreasing the reserve requirement is loose money. These are the projections, the expansion of $100 through fractional reserve. And so what that looks like is you put $100 in and the increase in how much it's able to move. When it's lower, more money, it influences the economy and its growth exponentially. Okay, open market operations are the purchase or sale of U.S. government bonds and treasury bonds. If you guys think back to your world or U.S. history classes of the past, you learn that the United States used to sell war bonds as a way to get money into the pocket of the government so that the government could pay for the war. After the war, the U.S. Government was able to buy back the bonds once the economy had stabilized, and they bought them back with interest, essentially. So the United States government was taking a loan from its people. So if they are selling bonds, that's tight money because it's slowing the economy. If you are asking people to give money to the government that they're going to tie up in a bond, think about the word bond. It is bonded, that you can't use this. You can't sell this back until the government says that it's ready to buy it back from you. It's almost held frozen. So if people have to buy the bonds, it removes money from circulation. If the United States government is feeling like they want to stimulate the economy or run more of a loose money system, then they will announce that they are buying the bonds back or treasury bills. And then people can take their bonds that look like this, if you have them in safes or locked away, then they can take them and get their money and interest back. And now people have more money to spend at the store or buy new shoes or put towards a vacation or a house or home or something like that. So when consumers or civilian money is tied up, when it's in the bond, then they can't use it, so that's tight. And when it's loose and free-flowing, imagine a guy who's got dollar bills in his pockets and they're poking out and he's dropping money all over the place. That's loose money. He's got tons of money to spend. Tight, he doesn't have it. It's all tied up. It's in the bond. All right, that's it for today. The next one that we look at will be fiscal. So that's it for monetary operations.